All right, everybody. It is Friday night. We are live here in the strategy room with the banker next door. Let's get rolling here. Hope everybody is doing great on this Friday night at the end of a long week with a lot of happenings. We had Labor Day, kids back in school, all that good fun stuff. So it's great. And I got to get through this quick because we got little Eagles action, Eagles in Green Bay going on here at I guess about 8:15, 8:20. Wearing my little Eagles shirt here, my little Jalen Hurts shirt to kind of keep my Eagles pride going, as it were. Is there anybody who's watched the channel for a little bit now knows I'm a pretty avid Philadelphia sports fan. So definitely excited about that tonight. But before we get to that, I got a lot of banking news, a lot of stuff to get through here. So let's open up with this. I'm going to just run through a number of episodes that I've posted here over the last 2 weeks just to kind of get some people up to date on that. So I did episode 198 was an update on bank stocks. Episode 199 was basically banks continue to reduce CRE exposure. Episode 200 was check fraud, still a big problem. Episode number 201 was, is the FDIC proposal on brokered deposits a problem? Obviously, a little bit of update on brokered deposits tonight, but that question still remains, and it's going to linger for a little while here. Episode 202, how can small banks level the playing field? I thought that was a really good episode. A couple things that smaller community banks could really look at in an effort to try to improve or try to maximize their strategy. Episode 203 was what is happening in the U.S. labor market. I will have a continuous update on that tonight as well. Obviously, a lot of market data coming out today, kind of jarring the market a little bit, as it were. Episode 204 was a review of Bank Directors 2024 Governance Best Practices Survey. So if you haven't had a chance to check that out, please do so. That's a really good one. A lot of good tidbits in that survey. Episode 205 was the FHFA's new credit scoring requirements. So if you are looking to get a residential mortgage soon, you might want to check that out because it's going to be pretty important. Episode 206 was basically what is the Jackson Hole Economic Symposium? I just wanted to cover that for basically anybody out there who wasn't really, they just had the Jackson Hole Economic Symposium a couple weeks ago. And just for anybody who really wasn't familiar with that, I wanted to try to cover it. Episode 207 was U.S. Treasuries manipulating interest rates. I talked a lot in that episode about the yield curve, which is what we're going to get into here in a minute. A lot of yield curve, a lot of interest rate information here. But what was happening in that episode, as far as what Janet Yellen was doing over at the Treasury with what the research paper that we analyzed in that episode, they basically created this term called ATI, activist treasury issuance, which is what they were saying which was what they were arguing was very similar to QE over at the Federal Reserve. And we're gonna talk about that a little bit, like I said, a little bit more in a minute. Episode 208 was It's Official, BLS, the Bureau of Labor Statistics, cooking the job numbers. Obviously, we saw a lot more jobs numbers today. Episode 209 was commercial real estate update. And hopefully if I can get to it, because we got a lot to get to here. If I can get to it by the end, I'll have a kind of a further update on just a couple other things that I saw with that. Episode 210 was an interview with Mark Ritter, who is a CEO of MBFS, which is a really interesting company that basically services credit unions around the country. They're basically an outsourced lending department, primarily doing commercial lending, but they also focus on SBA lending, some other things. But it was really a lot of fun doing that interview with Mark. And if you haven't had a chance to check out that interview yet, please go check it out. Episode 211 was, I basically said, let's check in on CEO salaries just to see, what's going on with not only CEOs in banking, but also CEOs in finance, CEOs for CEO salaries for the S&P 500. So check that out. It's kind of interesting. Then I did two episodes that were kind of like back to back. 212 and 213 kind of went together because the 212 was, is the Chinese property market affecting their banks? Like, in other words, the Chinese have had a giant real estate bubble bursting, and what effect has that had on their banks? It's had a big effect on them. And then episode 213 was, what are Chinese and Japanese mega banks currently doing in their respective market? And now, why does that mean anything to us? The reason why we have to keep an eye on them, obviously, because China is the number 2 economy in the world behind the U.S., but Japan is a major partner with the United States, and Japan and China happen to be the 2 largest purchasers of U.S. national debt. So when the Treasury goes to issue the debt, it's China and Japan that buy a lot of it. And they haven't been buying recently because they've both got their own kind of economic issues going on there. So I wanted to take a look at that. Episode 214, a really timely, important topic. How do banks feel about loan growth? We looked a little bit at the with a report that the Fed does, the senior loan officer opinion survey, which is a really good survey to look at to try to give us some indications there. I mean, obviously, growth has really slowed. It's not really great right now, but banks are basically expecting growth to pick up. So episode 215 was, what is happening at Customers Bank? Customers Bank got into kind of crypto assets and digital assets, as it were, and this is now starting to cause them some issues. Regulators not too happy with it, putting them under kind of a written consent order, and basically asking them that, seeing some deficiencies in what's called their BSA and AML lending. So again, I'll hopefully have another update that I'll be able to hopefully get to by the end here with that. And then episode 216 is, what is the discount window? And how do banks get access? And that, actually, believe it or not, that may seem innocuous at the moment, but that is actually going to probably end up being a very important episode, because if things go down, banks are going to need to go access that discount window. And when you're going to start to hear this on CNBC, like, oh, this bank went to go access the discount window, that bank went to go access the discount window. So, kind of watch that episode, because it'll give you a little bit more background information on that, and will kind of help out understanding some of these conversations, again, if you're not familiar with that. So, okay. So that was kind of a rundown of the episodes, and basically, this feels like I'm kind of working into a good format here, because what I'm going to start doing now is, I think Friday night seems to be the winner here. I think Friday night is going to be the best night for doing these live streams. So I'll probably be on here, and I kind of like 7 o'clock. That seems to be like a good time for people. So I think 7 to 8, 7 to 8:30. And then what I'm going to try to do is, I'm going to try to do basically 5 to 6 episodes every week. And so, try to have about an episode come out every day. And then I'm going to work on developing some exclusives for members. I was doing some live streams on Podbean for the podcast audience. I think I might just make that a more exclusive thing. Like, basically, if you become a member, I'll have like a kind of a once a month, like a private live stream on Podbean for members, and some other content and things like that I'm working on. So stay tuned for more information as it relates to that in probably the coming weeks and months, as this whole thing continues to develop. Also, I have a couple of announcements as far as things I'm working on here at the channel. So I figured I'd announce it now. So I'm working on a financial history series. I've got another gentleman who's going to come on, and we are going to do those as live streams. And we're going to do those on Thursday nights. It'll be one, basically, I've basically set it up to have kind of a first season, if you will, of financial history. We're going to focus on the 20th century and kind of a range of 12 basically big things that happened throughout the 20th century. And, we'll start with basically like the Panic of 1907 and kind of work our way all the way through, probably end up somewhere around 1998 with the almost failure of long-term capital management. And so we'll get into a bunch of big things and key players that in the world of finance that kind of went throughout that series. And like I said, I'll have somebody else who will co-host that series with me, and we'll do those once a month. They'll be on Thursday nights. and I will put out an official announcement. We'll probably do the first episode of that starting probably now. I would like to have done it in this month, but we'll probably get to that next month. So probably see the first episode there for that coming out in October, and I will have an announcement for that. And then also, I'm going to get into a little bit more AI and technology. So I've been sitting on a number of things that I really want to get into, and again, it's all related to banking, all related for finances. So this is AI. So this is basically technology in banks. A lot of the fintech companies, a lot of the different types of technologies that banks use, how AI is affecting all that, and just trying to bring in different things as it relates to that. So definitely have more information there coming out soon. Like I said, AI technology series, financial history series. So we'll definitely have more information on that. So with that being said, let's jump in real quick to what are some of the economic indicators that are going to be coming out next week. So Monday, September 9th, we get consumer inflation expectations. Atlanta Fed has the GDP Now numbers. That'll be very closely watched. Consumer credit. Then on Tuesday, September 10th, we have OPEC has their monthly report, and then we get the API weekly crude oil stock. Wednesday, September 11th, we get core CPI, and then we get regular CPI, and then we get the 10-year Treasury note auction. Thursday, September 12th, we get core PPI, the PPI month over month, initial jobless claims, 30-year Treasury bond auction, federal budget balance. And then on Friday, September 13th, Friday the 13th, we get export-import price index, Michigan consumer sentiment, Michigan consumer inflation expectations, and the U.S. Baker Hughes oil rig count. So a lot of really good economic indicators coming out next week. We're going to have a lot more inflation data with the CPI and the PPI coming out. And basically, obviously, a lot of eyes will be on the Atlanta Fed, the GDP Now numbers to see kind of see what they're currently looking at there. So we'll keep that going there. So let's get into the yield curve for a second here. So I have a video that I want to play everybody, and I hope, see if I can. You know what? I wanted to hang on a second. I think I missed it, guys. Hold on. I'll find it. Hang on one second here. One second. Technical. Here we go. Okay. There we go. Mhm. So let's take a look at that. And again, I hope everybody can hear this okay. Um, so I want to just stop and take a look back at this for just a second here. So here you had 1990, you had the invasion of Kuwait, then you had the tech bubble bursting, and then you had the housing bubble bursting. Is kind of the three main things that were going on here. So the question then becomes, what is the catalyst this time? And I would argue that the Federal Reserve has created what I call the everything bubble. In other words, everything's a bubble. Credit card debt, housing debt, student loan debt, auto loan debt, corporate debt. It's all a giant bubble. And it could all basically implode. So let's continue on here. This only has about another minute and a half left, and we'll go through here and see what they say at the rest of this. So, in other words, what they're saying here is the longer the yield curve inversion, the worse the recession that follows it. Now, I'm going to show you another chart here in just a second when this is done. Look at that. Today we are around here. The 1929 crash, the Great Depression. That's what we're we're measuring. You can see here the 1929, and this is what you would call, if you statistically, if you were analyzing this chart, you would call that an outlier. Yeah, we're all the way out here on the end of this thing. Okay, so I'll get it. But if anybody, so this account here on X, this is called Game of Trades, and this was probably one of the best yield curve videos I've seen put together in a long time. And it's a short, 5.5, 6 minute video, but I would highly recommend everybody go check this out and go watch this video again, because it's a lot of information packed in a very short video, and he really does an absolutely excellent job of kind of explaining the history of the yield curve, why the inversion of it is important. So let's go take a look at a couple other things here real quick. So I just want to show you guys that what we're, and here you can see kind of the 10-year note here and where it's kind of bouncing around. So the 10-year note basically ended the day here at 3.875. And the yield curve, as it were, is measured as the 10-year note versus the 2-year note. So right now you've got the 10-year is just above the 2-year. So 3.875 versus 3.75, which means that it's just back into positive territory. However, so when the yield curve first inverted, a lot of economists out there made the argument that oh, well, yeah, okay, the 2 years above the 10 year, but that's not really a true accurate. It would really be more the 3 month versus the 10 year. Now I know this chart here doesn't really well, it does give us the 10 year. The yield here is basically at little over 5% here on the 3 month, and you can see that versus the 3.713 here on the yield for the 10 year note. So you're still over 100 basis points above. So, so it's not, so like I said, it has technically reverted, so to speak, back to positive territory, but it's still, the 10 year is still well below even, all these other, the 3 month, the 6 month, the 1 year. It's still below that. So there's still technically an inversion there. Like to me, the Treasury bill won't be fully reverted back to positive territory until the 10 year is above what the 3 month is trading at. So now let's go take a look at one more thing here on this. So this is the Fred database, and I think this is the best way to look at this, and that to understand the yield curve. So here, the black line here, this is 0. This is your baseline. So this side over here on the left, this would be like a normal, what we call sloping yield curve. And you can see that this is going up here from about 2001 .com bubble burst. And then you can see it go back up here. And then even in 07, 08, we dropped down. You can still see, it's still kind of above there, even at zero interest rate policy, but we're still, still hanging here. And then it kind of dips down here in 2022, but then it kind of pops back up. And then it comes back down here in July of 2022, and we have been negative. Now, the right side here is negative. It's all below 0, so it's a negative, and this is thus the inverted yield curve. So this is the inversion here. And what is important to understand here, again, is that this is the longest and deepest inversion on history. And what the video we just watched, what that video was trying to point out is that the longer, if you go back historically and look at the numbers over the last, going all the way back to the Great Depression in 1929, so you're going back about, 90 years or so, you look back over that history, every time you have an inverted yield curve for a longer period of time, the recession that follows it is much, much worse. And what I've been telling for people for the last 7-8 months is that when this yield curve does go positive, look out, because that's when, generally the recession hits in about 3 to 6 months after the yield curve reverts back to a positive territory. So again, this going back to positive territory, to me, it's like, do you need that to happen? You do, because you do need to get back to a sloping yield curve. Having a negative yield curve is not a good thing. But here's another question here. So Janet Yellen over at the Treasury has, like I said before, I feel has been manipulating the yield curve for, the better part of the last, 8 months, 9 months. And like, in other words, if she hadn't been doing the things that she was doing over there, we would have seen this revert back probably as early as October of last year. And we probably would have been in a recession through most of this year already. But because she's doing, she's straight out. So the question is, why now? Why is this being kind of allowed to revert back into positive territory now? And is Janet Yellen still doing the things that she's doing over the Treasury? Now, I would go back here for a second and say that with the 3-month still over 5% yield, I would say, yes, she's still doing what she's doing over there. But like I said, for some reason, they're allowing this to happen or begin to revert back to positive territory. But this is not a good sign. That's my point here. So, okay, now that's our little spiel on the yield curve here. So now let's look at some of the employment stuff for a minute. Let's talk about employment for just a second. So Wells Fargo is in the process of, let me see if I have any of the employment stuff. I'll get into this in a second here. So I just want to read off some things here. So Wells Fargo cost cutting spurs hundreds of layoffs. So Wells Fargo basically cutting a bunch of jobs. The private employment growth slowed in August. So basically, ADP basically said that they had private employers added 99,000 jobs. The numbers today basically came in at 142,000. Still not as good or not anywhere near what they were looking for. Layoffs climb at certain types of businesses as the job market cools. So the layoff rate among small businesses with 1 to 9 employees more than doubled from 0.9% at the end of June to 2% at the end of July, according to the BLS, Bureau of Labor Statistics. That is also up substantially from the same time last year when businesses of that size had a 1.5% layoff rate. Small businesses with 10 to 49 employees saw layoffs grow from 0.9 in June to 1.2 in July, up from 1.1% in July of 2023. But the layoff rate among businesses with 50 to 249 employees dropped from 1.2 to 0.9% between June and July, and businesses with 250 to 999 employees held steady at 1.3% in that time frame. So, in other words, the picture that you're beginning to emerge is that basically small businesses, businesses that have basically 1 to 9 employees are the ones that are really taking it on the chin right now, followed not too far behind by businesses, small businesses with 10 to 49 employees. But this somewhat bigger small businesses are kind of holding steady. Now, the new BLS data also showed that the job market continues to cool with only about 7.7 million job openings at the end of July, down from 7.9 million at the end of June and from 8.8 million in July of 2023. I would also add to that in 2022, you had 12 million job openings. So in about a year and a half or so, we have dropped from roughly about 12 million job openings down to 7.7 million job openings. So you're talking about 4 million jobs going away there. Big issues there. And it's not just salary, but employers are also cutting back on other types of benefits. So, and then interesting, this was kind of an interesting article that I saw. So CEO exits hit a record high as companies cut costs and the labor market softens. So more CEOs have left their jobs year to date this year than in any other year over the last 2 decades, even as the pace of exits has slowed amid the softening labor market. So newly available research from executive placement and job coaching firm Challenger, Gray and Christmas indicates that 1,250 CEOs have announced their departures so far in 2024. That's 13% more than the same period last year and stands as the highest year-to-date total since Challenger began tracking the data back in 2002. So just something really interesting to note. That means that, you probably have a lot of retirements in there, but that also goes to show you that there's a lot of companies that basically can't afford that huge CEO salary. So now let's go back to X for a minute because I want to show everybody. I want to show everybody some of the job data stuff that was out here. This is another interesting thing. This is from the Kobezy letter. Interest expense on the U.S. federal debt is now at a record $3 billion per day. This is triple the amount paid 10 years ago and has doubled in just 2.5 years. Total interest costs on federal debt reached a whopping $1.1 trillion in the second quarter of 2024. That just goes to show you that our national debt and the interest alone of what we have to pay is not sustainable. So we could see here service sector saw a sharp upturn in activity in August. But the manufacturing PMI signals another contraction for August as new orders and production fell faster. Employment losses continued as inflation accelerated. And what, very interesting dichotomy there. What we've seen is that employment, or I should say manufacturing jobs have dropped by 25,000, but the government jobs have gone up by 25,000. So kind of an interesting thing there, but basically all of the jobs in certain sectors are just being completely propped up by government and government spending. And that's why you haven't seen this thing kind of fall apart. Breaking. So the June and July jobs reports have been revised lower by a combined 86,000 jobs. So the June jobs report was revised lower by 61,000 jobs from 179,000 to 118,000. And the July jobs report was revised lower by 25,000 jobs from 114 to only 89,000. And what does this say here? This means that the July jobs report was the weakest jobs report since the pandemic in December of 2020. And it says just wait till next month when we see the revision for today's numbers. So today's numbers came in at about 142,000, but you can see this massive deceleration here. We went so now as it stands, we had 118,000 in June, down to 89,000 in July. And the number reported today was 142, but I can guarantee you that the sun comes up tomorrow, that number will be down, revised below 89,000 for August come next month. That is, you can almost guarantee that. And then here's another great chart here. So this is for anyone not keeping track. There have only been 6 upward job revisions since January of 2023. Meanwhile, there have been 13 downward revision, with many of these reports being revised down not once, but twice. So market confidence in the labor market data is deteriorating. Something is wrong. Yes, I would absolutely agree with that assessment. Let's see here. Here's another one from EJ Antoni. He's a great guy. I've been following for a long time, has some great charts and economic numbers and stuff that he puts out. But once you factor in the millions of people missing from the labor market, don't have jobs, but are excluded from official unemployment calculation. In other words, what you could call the U6, the official unemployment rate, the unemployment rate jumps from 4.2% to somewhere between 7 and 8.5%, depending on the methodology. And yes, this is what I have been saying for a long time. The headline number you get is what's called a U3. And I think that's actually the worst evaluation of the unemployment data. It's actually the U6 is the far better, more accurate number. And that number has been trending around 6.7% for actually quite a while now. So the June and July jobs numbers were revised lower. And yeah, we already kind of saw that. So here's an interesting one. So the SOM rule was triggered. It has anticipated the last 9 recessions and has a 100% track record. This should not be overlooked. So basically you can see here's the last 9 times on the chart here that it was identified. And yeah, so you can see here, that's not a good thing there. More than half of the last 12 months of job growth has come from the government and the government-dominated healthcare sector. So basically, it's all about taxpayer funded, and it's not at all sustainable. Yes, I would agree with that. Oh, here's one of my favorite charts. Look at this thing. So this is the Federal Reserve. This is the money that the Federal Reserve has lost in the last year. Look at this. Little bit of a profit, and then boom. Talk about falling off a cliff. Like, holy cow, straight on down. So Powell and company have managed to lose $195 billion despite having a money printer. I wish I had a money printer, but I don't, unfortunately. Okay, here. Another month, another record high in the number of government jobs. So you can see that here, government jobs upwards of about 22,000. Nope. I'm sorry, 23.5 roundabout here. Part-time jobs jumped again in August while full-time jobs declined. So since June of 23, we have lost over 1.5 million full-time jobs while adding just over 2 million part-time ones. Does this look like a robust labor market to you? I would say no. And here's the key thing here. Those full-time jobs, those are good white collar, for the most part, 6-figure paying jobs. And now you're losing those and they're being replaced with part-time, lower paying part-time jobs. Not a good thing, not where you want to see the government go. Peter Schiff, another guy I like to follow on X, has got some great takes on certain economic things. He writes just 142,000 jobs were supposedly added in August, below the 160,000 estimate, with significant downward revisions to prior months. More importantly, manufacturing lost 24,000 more jobs while the government added 24,000 jobs. Replacing good producing jobs with government jobs means higher inflation. Bingo right there. Manufacturing jobs add productivity. You're making something, you're helping the economy grow. Government jobs make nothing, produce nothing, and do not help the efficiency of the productivity of the economy in the least, but it does give you more inflation. Okay, here. Unemployment growth since June of 2023 has been 100% driven by net additions of part-time work. Full-time jobs have disappeared, and that trend continued in August. So you can see here part-time jobs like way up, full-time jobs negative. But here's perhaps the worst thing. Employment among foreign-born workers has increased 4.4 million since the pre-pandemic and is back on trend, while jobs among native-born Americans have fallen 833,000 over the same time. Literally no progress in 5 years. That's just unbelievable. Here's another chart looking at that. Foreign-born workers plus 635,000 in August. Native-born workers minus 1.3 million in August. Yes, 1.3 million native-born Americans lost a job in August. So think about that. All right, we kind of looked at that. All right, I think we got that. So, okay. Let's get into some other news here real quick. I wanted to give us kind of the news of the week here. So let's get into kind of take us out of that for just a second here. So let's get into some news here. So the FDIC saw continued weakness in U.S. banks' certain loan portfolios, particularly office properties, credit cards, and multifamily loans that warrants monitoring despite improved second quarter earnings due to lower non-interest expense and one-time gains. In a statement, the FDIC noted that the non-current rate for non-owner occupied commercial real estate loans driven largely by the biggest bank's office portfolios rose to 1.77%, the highest level since the third quarter of 2013. So yes, we are seeing continuous weakness in banks' loan portfolios as it relates to commercial office properties in particular. Bank of America Corp is looking into a whistleblower's allegations that its bankers in Asia shared non-public information with investors before a large stock sale for a corporate client in India this spring, the Wall Street Journal reported, citing a B of A spokesman. B of A bankers sought meetings with investors, including quantitative trading firm Jane Street, Norges Bank, and insurance company HDFC Life Insurance Company ahead of the $200 million public stock sale for Aditya Barla in March, the report said, citing company records. Lawyers tapped by B of A to investigate the complaint have interviewed bankers involved in the sale, the report added, citing people familiar with the probe. Now, why did I include this one? I included it because of Jane Street. If anybody remembers, if the crypto series that I did talking about the implosion of FTX, you will know that where did Sam Bankman-Fried come from? Oh, that's right. He came from Jane Street. That's where he learned to trade. Jane Street also had holdings in FTX and traded through FTX into the crypto markets. So Jane Street always seems to come up in a lot of shady things here. So just wanted to, not accusing, just pointing it out. Okay, Republic First Bancorp filed for Chapter 11 bankruptcy in the U.S. Bankruptcy Court for the Eastern District of Pennsylvania on August 27th, according to a September 5th regulatory filing. On the same day, Thomas Giesel resigned as CEO of the Philadelphia-based company, and Michael Harrington resigned as CFO, according to the filing. Republic First, of course, was sold to Fulton Bank. The Consumer Financial Protection Bureau in a report highlighted aggressive and illegal practices in the collection of medical and rental debts, saying problems with real estate companies' revenue management software can result in inflated rental debt amounts. The agency said some debt collectors also try to collect medical bills already satisfied by nonprofit hospitals' financial assistance programs. So something interesting to keep an eye on there. The Federal Reserve is seeking public input around the operational practices of its discount window, which provides short-term credit for banks and credit unions. The comment period will close 90 days after the request for information is published in the Federal Register. Now, if again, as I talked about a little earlier, was the episode that I just did on the discount window. So if you want a little bit more understanding of that, go check out that episode. Now, the question becomes, why would they be asking for public comment on that? And I think it's interesting timing that they would be asking for public comment on that. I don't know. I might speculate. Maybe it has something to do. So the discount window has always been a stigma for community banks because the Fed is the lender of last resort, and it's always been looked at negatively. Like, in other words, if you are borrowing from the discount window, that means that your bank must be in trouble. You must be on the verge of going under. And so a lot of smaller banks have avoided the discount window like the plague. So maybe that's what could be playing into some of that. Maybe they're trying to get a feel for how people and banks view the discount window. I don't know. I'm speculating there. Don't know for sure. Okay. Little economic data. Services sector index increases in August. Economic activity in the services sector increased slightly in August, the second straight month of growth, according to the Institute for Supply Management. Okay. Maryland-based Sandy Springs Bancorp, the parent company of Sandy Springs Bank, is considering selling the company, Bloomberg News reported, citing people familiar with the matter. Sandy Spring is working with financial advisors and has had deal talks with potential buyers, including Virginia-based Atlantic Union Bank shares, the sources said. Discussions are preliminary, and Sandy Spring could choose to stay independent. Morrisville, Vermont-based Union Bank shares completed a balance sheet repositioning related to its investment securities portfolio. The company announced that its subsidiary Union Bank executed the sale of $38.8 million in book value of its lower-yielding available-for-sale debt securities for an estimated after-tax realized loss of about $1 million, which will be recorded in the third quarter. Now, I pointed this out because banks are still adjusting their investment portfolios. As I've reported in many episodes over the last 6-7 months, banks have had a huge problem since interest rates went up. They have what's called unrealized losses in their bond portfolios. And I'm going to talk about this more here in a minute when we get into a couple other articles here. But this is a good example of the fact that many banks out there are still working to correct these, imbalances, these potential losses in their bond portfolios right now. So I just point this out to show that this trend is continuing to go on. Deriving lessons from its risk management failures, TD Bank is working toward enhancing its cross-company communication system as part of its efforts to overhaul its anti-money laundering program. CEO Masrani told analysts at the Scotiabank Financials Summit, "It's easy in a bank of our size to sometimes not look at accountabilities as clearly as we should." Masrani said, "There's lots of information available, and it's important to coordinate and make sure that the right information is available to the right individuals in the right areas of the bank on a real-time basis." So for anybody who doesn't know, TD Bank has been mired in this major AML and BSA issues. They're getting hammered by regulators. They've had to pay fines. They've laid people off. It's been kind of a mess. 6 credit rating agencies, including Moody's Investors Service, Fitch, and S&P Global Ratings, agreed to pay a combined penalty of more than $49 million to settle SEC charges of record-keeping failures related to off-channel employee communications. Moody's and S&P will each pay a $20 million civil penalty, while Fitch will pay $8 million, according to a September 3rd release by the SEC. The companies have begun implementing improvements to their compliance policies and procedures. California-based Manager Research Affiliates LLC is launching an exchange-traded fund that will invest in companies dropped from big indices such as the S&P 500 and the Russell 1000, the Financial Times reported. The company's first ever ETF will be called Deletions ETF and will have a ticker NIXT, the report said. So it's kind of interesting. They're going to be looking to invest in companies that have been dropped, not added, but dropped. So it's kind of an interesting methodology there they're using. So Robinhood Markets unit Robinhood Crypto LLC reached a $3.9 million deal with the state of California to settle allegations of blocking customers' withdrawals from their accounts between 2018 and 2022 and misleading them about the platform's trading and order handling practices. California Attorney General Rob Bonta said in a statement September 4th. I don't. Anybody knows I don't like Robinhood. I don't care for Robinhood. I think these guys are shady. I think they have shafted their customers on numerous occasions, and that's just my take on them. But I think they got off easy here. Elsewhere, Robinhood is now allowing its UK-based customers to lend the stocks they own in their portfolio to interested borrowers for a passive income in the form of monthly interest, and that was reported by CNBC. We'll see how that works out. The Federal Deposit Insurance Corp, the FDIC, selected Boston Consulting Group, Federal Corp, to advise and assist in the implementation of an action plan toward fixing its workplace culture based on recommendations from the FDIC Office of the Inspector General and a third-party review. So that whole FDIC situation there continues to unfold. Keep an eye on that. Industry groups and financial companies push back against the Consumer Financial Protection Bureau's proposed earned wage access rule in comment letters to the agency last week, arguing that earned wage products do not constitute as lending and hence lending laws should not apply on them. Banking Drive reported. What else we got? Economic activity slows from the Fed's beige book. Economic activity declined or remained flat in 9 of the 12 Federal Reserve districts, according to the Fed's latest beige book of regional economic conditions. Wage growth was modest, consumer spending ticked down, manufacturing activity declined, and residential and commercial construction and real estate activity were mixed. But most districts expected economic activity to remain stable or to improve somewhat in the coming months. Okay, let's see what else we got here. Berkshire Hathaway has shed nearly 15% of its stake in Bank of America Corp after selling more shares on August 30th, Barron's reported, citing a regulatory filing. The insurance conglomerate has so far realized about $6 billion from a series of share sales that started in mid-July. According to the report, the Berkshire selling appears to have depressed Bank of America stock in the past 6 weeks, with the stock trailing those of its peers, including JP Morgan Chase. So basically, Warren Buffett is continuing to sell and build his war chest. Like I said before, he's got this ginormous, it's got to be approaching $300 billion plus war chest. Berkshire Hathaway also now owns more treasuries than the Federal Reserve. Think about that for a minute. Warren is basically, so Warren is no dummy. And if you should watch what Warren does very closely, because basically what he's graphing to you is that he sees trouble. He's in this boat seeing the storm a coming. And so keep an eye on that, because that kind of dictates that not great things are coming down the road there. So, okay. U.S. banks lending for home construction fell by more than 10% year over year in the quarter ended June 30th, the largest yearly decline in more than a decade. The Financial Times reported, citing an analysis by BankReg data of the most recent FDIC data itself. So home construction fell by more than 10% in the year quarter. So banks tightening up there, as it were. Let's see what else we got. Personal income grew slightly. Consumer sentiment rises in August. Agencies issue guidance on cybersecurity assessment tool sunsetting. So the FDIC and the OCC issued bulletins on last week's interagency announcement. The regulators are sunsetting the cybersecurity assessment tool on August 31st, 2025. So in a statement last week, basically FinCEN, so while what they call this the CAT. So while the CAT, a voluntary tool released in 2015, remains sound, several new and updated government and industry resources are available to financial institutions. So banks can use the National Institute of Standards and Technology Cybersecurity Framework 2.0, the Cybersecurity and Infrastructure Security Agency's Cybersecurity Performance Goals, and CISA's pending Cybersecurity Performance Goals for the financial sector. And I will be practicing tongue twisters later on. The CFPB, Consumer Financial Protection Bureau, is targeting rentals and medical debt in the latest report. What I kind of just talked about a couple minutes ago. So the CFPB issued its annual report to Congress on debt collection, which focuses on medical debt and rental debt. And they kind of talked about with companies, management software, attempts to collect medical bills, so on and so forth. Okay, the ICBA, Independent Community Bankers Association, ICBA, said that the AML and CFT modernization should not expand the regulatory burden. So ICBA told the Financial Crimes Enforcement Network that its proposed rule to update anti-money laundering and countering the financing of terrorism programs would create additional burdens on banks without benefiting FinCEN's efforts to reduce financial crimes. I would agree with that. The ICBA, the proposed expansion of the FedWire NSS operating hours are not necessary. ICBA said the Federal Reserve's proposed expansion of FedWire Fund Service and National Settlement Service hours to 22 hours per day, 7 days a week, would place significant burdens on community banks for what is likely to be a low volume of transactions. Again, I'd agree with that. Okay, talked about that. CNBC features opposition to credit union acquisition of community banks. So ICBA's campaign spotlighting credit union tax and regulatory inequities generated new coverage this week with a CNBC segment on acquisitions of community banks. CNBC segment appearing on Squawk Box and Power Lunch. CNBC's Leslie Picker said record high credit union acquisitions of tax-paying community banks have become controversial. Critics say credit unions' tax-exempt status gives them an M&A advantage, and their scale no longer justifies the $21 billion in annual taxpayer subsidies they enjoy. Yes, that is a fact, 110%. Okay, the OCC's head, Michael Hughes, basically gave a speech this week in Germany where he said the combined assets in the largest U.S. banks may reach $26 trillion over the next 10 years, and there must be commensurate strengthening of supervision and regulation. Yes, I agree with that. And I think we need to have a conversation about whether or not some of those banks need to be broken up. FBI basically says North Korea targeting the crypto industry. According to an FBI alert, teams of North Korean malicious cyber actors are targeting specific decentralized finance or cryptocurrency related businesses with social engineering to gain unauthorized access to companies' networks to deploy malware and steal cryptocurrency. So very interesting. Could lead to a good cryptocurrency series episode if we have more information on that. From the FTC, Bitcoin ATM scams have increased tenfold. So since 2020, the amount consumers reported losing to scams involving Bitcoin ATMs has increased nearly tenfold to over 110 million in 2023, according to the FTC. The FTC noted that fraud losses to Bitcoin ATMs have topped 65 million in just the first 6 months of 2024. The majority of scam losses involving Bitcoin ATMs involve government impersonation, business impersonation, and tech support scams. So kind of interesting. More stuff to come there. Again, as I reported, construction spending dropped in July and manufacturing contracted in August. Okay, let's jump into some other articles. Let's get back over here for a second. Let's just run through here. So Treasury yield curve inches toward normalcy as the bond market readies for Fed cuts. Yes, absolutely. So a little more than 2 years after inverting, a key spread in Treasury yield curve has returned to positive territory, with the Federal Reserve ready to start cutting interest rates later this month. And yes, and we talked a lot about the yield curve earlier. U.S. banks invest cautiously in bonds with rate cuts on the horizon. So the U.S. banking industry is proceeding with caution when it comes to investing in the bond market, even as the Federal Reserve is widely expected to begin cutting rates soon. So, and here we can kind of see total U.S. bank securities holdings. So my question to everybody would be this: why do you think they would be hesitant here? Well, because of what I had mentioned earlier with the giant amount of what's called unrealized losses in banks' bond portfolios. That's why they are hesitant here, because what happened, in 2022, basically 2021, beginning of 2022, The banks did not believe that the Fed was serious when they said they were going to increase interest rates. So what happened? The banks went long, betting the interest rates were going to stay low. They went long on bonds. So when the Fed started increasing the interest rates, those bonds dropped in value majorly, significantly. I want to see, you know what? Let me see if I can find something here real quick, because I did have a great chart that illustrated this. If I can find it here. Yes, right here. This is great. Peter St. Onge. If anybody doesn't follow Peter or listen to his podcast, definitely go check it out. So on the left, we have the great financial crisis of 2008. And on the right, we have, I can't say that. What do we call this? So this is what we're dealing with right now. This is the amount of unrealized losses on investment securities and bank bond portfolios. That's where we're sitting at right now on the left, or on the right, rather, on the right. This is what we're looking at. And this is why banks are being cautious here, because they don't want to mess up and make the wrong step. Okay. U.S. banks broker deposits ticked down. So as I hinted at a little earlier, so broker deposits fell slightly at U.S. banks in the first half, the same period in which the FDIC proposed a mandate that would change the classification rules for determining which deposits are considered brokered. Brokered deposits at U.S. banks dropped as a percentage of total liabilities to 6.2% in the first half, from 6.3% in the previous half. According to analysis by S&P Global Market Intelligence, the dollar amount of broker deposits fell to $1.3 trillion, so just a little slightly from $1.349 trillion. So still the totals were well above their recent trough of $600 billion and 2.8% of total liabilities at the end of the second half of 2021, when the numbers dropped following the FDIC's rule from December 2020 that created a new framework for classifying deposits as brokered. So so you can kind of see here 2019, and then this dip down, and now we go back up. So, and then let's see here, we're continuing along. Most banks report long-awaited margin relief in the second quarter. So most banks' net interest margin rebounded in the second quarter as loans grew at a quicker pace than in the prior quarter. Funding costs continue to grind higher, but banks grew loans at a quicker clip in the second quarter and saw the yields on their loans grow as well, leading to stronger margins for most banks. That's good. Good performance. Stronger loan growth supports margins. However, loan growth really hasn't been that great. Okay, and then what else? A couple of things I wanted to get to before we get out of here. I had a couple more minutes here. So let's get out of that. Bank stocks fall in early September after 2024 closing, halting at the end of August. U.S. bank stocks take a breather after the July rally. That's one way to look at it. What else we got? Three banks, $1.3 billion in assets added to the FDIC's problem bank list in the second quarter of 2024. So not anything big. The number of banks on the list, the problem bank list, increased to 66 from 63. So, again, nothing real crazy, but it's just something to keep an eye on. And then this I thought was kind of cool. The new women-owned bank is part of Columbus, Ohio. So Ohio's first majority women-owned bank is expected to open in September, making Columbus, Ohio, the metropolitan statistical area with the most de novo bank openings in the country since 2019. So despite regulatory scrutiny on de novo banks and recent historic lows for new bank openings, Fortuna Bank's organizing team was able to gain conditional approval from state and federal entities and close its $20.7 million capital raise July 30th. Fortuna's team is comprised of Columbus de novo veterans, easing investor concerns due to the city's de novo history, one of multiple profitable new banks providing attractive returns for shareholders. So that's pretty awesome. Good for them. Good for them being able to get that thing off the ground. So, okay, let me check comments here for a second. Any questions here? Let's see. What do we got? What are your thoughts about Verizon spending $20 billion to purchase Frontier? Honestly, I'm not real sure. I'm not real. I didn't really read much about that Verizon spending $20 billion to purchase Frontier. I can take a look at it and get back to you. There's, like I said, there's always next week. I can always try to respond to that. But I appreciate the questions. And then let's see, what else do I have? So Connect One. This is a kind of a bigger merger that was just announced here in the last day or two. So Connect One Bancorp will take on roughly $500 million of multifamily loans collateralized by rent-regulated apartment buildings in New York City in its $284 million acquisition of First of Long Island Corp. And plans to build credit reserves accordingly. Investors have feared credit deterioration in rent-regulated multifamily, in part because building owners have had difficulty increasing property revenues due to newly imposed regulatory restraints, while expenses have continued to rise. Uncertainty in the segment has hurt share price at some banks with higher exposure. So Connect One is basically they're inheriting a certain chunk of commercial real estate here as part of this acquisition, and they plan to basically beef up their reserves. But New Jersey-based Connect One, the holding company of Connect One Bank, agreed to acquire Melville, New York-based First of Long Island Corp., the parent company of First National Bank of Long Island, in an all-stock deal valued in approximately $284 million in the aggregate, or approximately $12.40 per First of Long Island share, based upon Connect One's September 4th closing stock price of $23.97. The combined company will operate under Connect One brand and will have approximately $14 billion in total assets, $11 billion in total deposits, and $11 billion in total loans, according to a press release. So pretty good size acquisition there. Connect One has been a pretty successful bank up there in that kind of New York, New Jersey market for a while now. And, kind of kudos to them. They probably figured they had to do a merger to jump over that 10 billion mark, which is good. And then let's see here. Let's get to, I will save this for another time. So I want to wrap up with just a couple of follow-up stories here to some of the episodes that I have done over the last couple of weeks. So mainland China, Hong Kong private equity investments in Western markets surge. So capital deployment by mainland China and Hong Kong-based private equity investors into the U.S. and Europe, including the U.K., has swelled this year, even with tighter U.S. and European government scrutiny of Chinese inbound investments. So the aggregate transaction values reach 11.05 billion in the year through early August, a significant increase compared with full year 2023, which recorded just 5.92 billion. So the number of deals is on track to at least match last year's 245 total, with 196 transactions announced so far in 2014. However, there is a lot of scrutiny of Chinese investment, and it is growing. So you can understand some concerns there. Customers Bank. I did the episode on kind of what's going on with Customers Bank with their digital asset investing. And it says this was from Tuesday. Customers Bank to launch a new payment platform with enhanced BSA AML compliance. So Customers Bank is gearing up to launch a new business-to-business payment platform that will offer broader services and enhance compliance capabilities following an enforcement action from the Federal Reserve that required it to improve risk management in its digital asset strategy. Customers is testing the as yet unnamed new platform with some clients and expects to launch it in the next quarter or so. President and CEO Sam Sidhu said in an interview, the new platform consolidates customers' technology solutions and treasury management, instant payments, and uses APIs for companies to plug in other software or payment products they use in day-to-day operations. So kind of interesting. And basically, the new platform will reflect customers' vision to grow fee income from the payments business, in contrast with the existing payment network, the CBIT, which has primarily been a deposit play aimed at generating interest income. So just, kind of interesting there. So customers trying to react. Obviously, their stock price took a hit with the announcement, and they're trying to make good on some things. So, commercial real estate wise, commercial real estate loan delinquencies reaccelerating as loan growth slows. So overdue commercial real estate loans ticked up further as acute stress in the office sector continues to work its way through bank portfolios. Criticized loans continue to pile up at U.S. banks as credit weakens. So weakening credit quality and persistent pressure in the commercial real estate sector are pushing U.S. banks' criticized loans higher. As of June 30th, U.S. public banks' median ratio of criticized loans to Tier 1 capital was 18.6%, up from 15.06% at year-end 2023, and the highest level since reaching 23.18% at year-end of 2020. So definitely, so criticized loans are piling up. So what is a criticized loan? A criticized loan. So basically, every bank, when they make a loan, they have to do what's called a risk rating. So you have a risk rating scale. They can basically be like 1 to 10. Think of 1 as being the best and 10 as being kind of a write-off. Most of the loans are going to fall in that probably 4 to 5 category. A 6 is going to be a watch list. Then after watch list, you get to basically, and then you start to get to like non-accrual, meaning they're not paying you. And in other words, watch list means they've got problems. Number 7, 8 means they're not paying you. Number 8, number 9 basically means you're not getting paid. There's 0 chance of getting paid. So what has been happening at banks, I've talked about in the past, is what's called, they've been doing what's called extend and pretend, meaning that, they know they have problems. They know they have loans with problems. So they're instead of, as the loans reach maturity, they're just extending those loans, pushing them off and pretending, hoping that the problems will go away or will get better. But what we're seeing now is that basically problem loans, they continue to criticize loans, continue to pile up on these banks as credit continues to weaken. And just note some other interesting things that Sweden, I did some update on kind of how commercial real estate was affecting basically banks over in Europe, and basically their problem loans climb at Sweden's top banks amid commercial real estate sector challenges. Some of that happening in Europe, but some of those undoubtedly loans here in the U.S. And that's why I pointed out, so you can just see that commercial real estate is affecting banks in Europe, not just banks here in the U.S. U.S. equity REITs traded a lower discount to NAV in August. But here's the interesting thing about this report is that I wanted to point out the type of properties. The number one properties trading on discount right now are actually hotels. Hotels traded at a 26.5% discount, median premium discount to NAV. That I found very interesting. I might have to talk about more about that in a later episode. And then finally, last thing I got, this was on a property in Philadelphia, being from the Philadelphia market here. So 1500 Spring Garden Street. Spring Garden's big area, big street in Philadelphia for anybody not familiar. But the assessed value of 1500 Spring Garden Street has been chopped in half in another example of the plummeting value of office buildings across Philadelphia. The Board of Revision of Taxes revised the city's assessments on the 13-story office building down from $192 million to $101 million in 2023 and $87 million in 2024, and from $159 million to $76 million in 2025. The reductions add up to a combined loss of $280 million, or 51% in assessed value over the 3-year period. It is a decrease of 47% in 2023, 55% in 2024, and 52% in 2025. The massive drop in the city's tax assessment for 1500 Spring Garden Street was the result of a successful appeal by property owner Nightingale Properties and Intervest Capital Partners, formerly Wafra Capital Partners. Given Philadelphia's property tax rate of 1.399.8%, Nightingale and Intervest are responsible for paying $3.7 million to the city for the 3-year period. They would have been responsible for $7.6 million prior to the revision, meaning that they saved $3.9 million on their tax bill, meaning that hiring that lawyer and probably paying them a couple $100,000 to take care of this for them was well worth it. That was money well spent. The office building is currently 70% occupied, according to Lawrence Aram, the lawyer for Clenheron Harvey Brasenberg, who represented the owners in the appeal. Upcoming lease expirations could drop, however, the occupancy rate to 50% within a year. So earlier this summer, 5 Center City office buildings combined to sell for 61% less than their assessed value. Incredible. In Center Square, the 1.76 million square foot office complex at 1500 Market Street that is also owned by Nightingale and Intervest received a 31% reduction in its 2024 property assessment from 362 million to 250 million. Citywide office properties lost 635 million in assessed value from last year when 2025 property assessments were released earlier this month. City officials are anticipating that number will end up around or above 1 billion following appeals. So that is just an example of what's happening with commercial office properties in Philadelphia, let alone, and these same properties are permeating throughout every major city in the U.S. And so Philadelphia just getting absolutely pummeled right now on commercial office buildings, as well as I'm sure many other cities around the U.S. are doing as well. So, okay. With that, I'm basically going to wrap up. That's a lot of information that we touched on. I just want to check here. Do I have any more questions? I do not see any more questions at the moment. So just keep an eye out. I will have more episodes coming out this weekend, going into next week. I'll make sure to set up. Will be another live stream coming at you next week at kind of same bat time, same bat channel at Friday night at 7:00. As always, please leave your comments on the video. I love getting back to people, letting everybody know what's going on. Please remember that we are on YouTube, Rumble, and all major podcast platforms. Make sure to check out the bankernextdoor.com. That there's, as I put, I try to put more information on there, constantly making changes to the website and updating things. So a lot of good stuff coming in there. But a lot of things. It's amazing to me right now what is happening. So much economic data, so much information out there at the moment, so many different things kind of coming together at the same time. And the key is that not just looking at one thing, but trying to take in the entire picture and taking a step back and saying, what's going on here? What's really happening? But anyway, all right. I know the game's about to start here. So everybody have a great night. Enjoy the football game. Have a great weekend out there. And I will see everybody next week. As they say, arrivederci. Later. Oh, wait, I gotta do my close up here. See you, everybody.